Good morning, everyone. Good morning. I am Matt Ewalt. I serve the Texas Tribune as Director of Events and Live Journalism. Welcome to those of you joining us in person and those of you joining us online for today's conversation, The Texas Economy, How Well is the Engine Running?, featuring Dallas Fed official Roberto Coronado in conversation with Texas Tribune CEO Sonal Shah. After 2 years of fast economic growth in Texas, analysts began 2023 with concerns about an economic slowdown for the state. As the year enters its final quarter, how is the state's economy faring? What does it mean for Texans, and what might 2024 bring? This timely and wide-ranging conversation on the economy will focus on the implications and opportunities for Texas families and Texas communities. Before we begin today's program, I'd like to acknowledge today's sponsors. Our major sponsors are Texas 2036, the Texas Association of School Business Officials, and Texas State Technical College. This event is also supported by the Texas Construction Association. Though corporate sponsors and donors underwrite this event, they play no role in determining the content, speakers, or line of questioning. We are on the heels of our largest event of the year, the Texas Tribune Festival, where we hosted 3 days of conversations like the one you're about to enjoy. Select TribFest sessions have been made available and can be found alongside our newsroom's coverage of the news made at Festival. All this and more can be accessed at texastribune.org. We hope you'll also join us next Thursday, October 5th from 9 a.m. to 1 p.m. at Angelina College in Lufkin and online for a multi-panel conversation on the November election and what's at stake for Texas and Texans. We'll look at the significance of constitutional amendment elections and why they need to go to voters for approval, provide an update on changes to election laws across the state, and review the 14 ballot questions all Texas communities will vote on. Additional panel conversations will focus on the implications of property tax cuts around the state and what the November election means for infrastructure investments in broadband, energy, and water. You can find more information on the Texas Tribune events page at texastribune.org/events. We thank those Texas Tribune members who are joining us in person and online today. Our journalism across all formats thrives thanks to the support of our members. That's why we are fully committed to achieving our ambitious target of welcoming 500 new members during our fall member drive. Good news is we're already over 50% to our goal. Texans deserve the truth, and we're dedicated to delivering it. We hope we can count on your generous contribution, no matter the amount, to empower our mission. You can show your support by going to texastribune.org/donate and donating today. Today's program will run an hour with 45 minutes or so for conversation and 15 minutes for your questions. Here in Austin, we have mics for our in-person audience. Our virtual audience can also submit questions online at our Q&A portal. That's at texastribune.org/ask. So texastribune.org/ask. So let's get to know today's speakers. Roberto Coronado is in charge of the Dallas Fed, San Antonio, and El Paso branches. He also oversees law enforcement functions, government relations, and economic education programs across all offices of the 11th Federal Reserve District. Coronado is a senior economist and member of the regional group of the bank's research department, and in that capacity, he provides regional input into the Dallas Fed's monetary policy process and is responsible for monitoring and tracking economic and business activity in West, Central, and South Texas, as well as Southern New Mexico. Sonal Shah is the Chief Executive Officer at the Texas Tribune. She has started and led social impact efforts in academia, government, and the private and philanthropic sectors for over 25 years. Previously, she served as interim executive vice president at United Way Worldwide. Sonal founded the Asian American Foundation in Houston and founded and led Georgetown University's Beek Center for Social Impact and Innovation. Her background in government and policy includes leading the White House Office of Social Innovation and Civic Participation in the Obama administration, serving as an international economist at the Department of the Treasury and as policy director for Pete Buttigieg's presidential campaign. In the private sector, Sonal led Goldman Sachs' environmental strategy and Google's global technology and impact investments initiatives. With that, I turn the program over to Tribune CEO Sonal Shah.
Thank you, Matt, and thank you for all of you that are here, but also online, and really appreciate having you here. Roberto, it's so great to have you here. I know we've talked over the phone several times, and it's great to have you in the audience and with us on stage today.
Sonal, thank you so much, and good morning, everyone. It's a real pleasure to be here, and Matt, thank you for getting us started. And Sonal, looking forward to today's discussion, and yes, we're very excited to be here.
Well, fabulous. Well, today our intention is to talk about the Fed, what the Fed does, also then bring that into what it means for Texas and what it means for our economy and our growth. Let me just start with the Dallas Fed is based in Dallas, but I mean, the Fed is based in Dallas, but you cover San Antonio, El Paso, other places. Tell us a little bit about the Dallas Fed and how it interacts, because when we hear about the Fed, we generally hear about interest rates going up, interest rates going down. But what is the role of the Dallas Fed?
Absolutely. Thank you, Sonal. Thank you for getting us started with that question. So the Federal Reserve Bank of Dallas, we are one of 12 regional banks across the country. And I'm sure we'll talk a little bit about the Federal Open Market Committee, and we can address the structure there. But the Dallas Fed, like you said, we are based in Dallas. That's where our head office is. We have 3 branch offices, one in Houston, one in El Paso, and one in San Antonio. And we're responsible for serving the entire state of Texas, the northern part of Louisiana, and then the southern part of New Mexico. And when you think about the Federal Reserve, to your point, we're the central bank of the United States. We were created by Congress in 1913, and there are 12 regional banks across the country, and we're the boots on the ground in the Southwest, in the 11th district. We predominantly, as a central bank, we provide the nation with a safer, more flexible and more stable monetary policy and financial system, but we do predominantly 5 things on behalf of the American people. First, to your point, interest rates, monetary policy. So we, with the Federal Reserve, we're in charge of, as a central bank, of setting up and establishing monetary policy for the country, and we do that with a dual mandate. We are one of the few central banks around the world in which we have a dual mandate. By dual mandate, that is we set policy with 2 goals in mind. One is we want to achieve maximum employment. We want to have an economy who's growing, but then we also want to make sure that prices stay in check, that we have price stability. The second aspect is we do a lot of work around financial stability. We want to make sure that the financial system in the U.S. is stable and it's sound. The third one, it's around financial institutions. We're one of the few regulators that we have in our country, so we supervise and regulate financial institutions to ensure that they are safe and sound for all of us. Fourth, we play a very important role in the payment system. We want to ensure the payment system is effective and efficient and is working properly. And then the fifth element is we spent a lot of time thinking about consumer and community issues to make sure that consumers and community have access to financial institutions, access to credit. And so we spent a lot of time thinking about that. So we do that as a central bank nationally. The Dallas Fed is responsible for executing those 5 functions within the Southwest, within Texas, northern Louisiana, and southern New Mexico. And then maybe the last thing I'll mention, Sonal, is I would like all Texans here and listening across that, you know, your central bank, the Dallas Fed, and the Federal Reserve System is both independent and accountable. What do I mean by that? Independent is that we are a central bank that we set policy in a nonpartisan, apolitical way, trying to always achieve the mandate that Congress provided us, and accountable also in the sense that we do this on behalf of the American people, all of you in Texas, but we also are responsible, accountable through the U.S. Congress. And so those are the key elements that I would like to highlight. And then before we go too far in the conversation, something I forgot to mention at the beginning is, as any disclaimer of a central banker, you know, everything that I just said or everything that I'm about to have a conversation with you, so now, are only my views, and they don't necessarily reflect the views of the Dallas Fed or the Federal Reserve System. But that, in a nutshell, is what the Dallas Fed is and how we operate and how we are engaged in our communities.
And you just have a new president came in. She came in a year ago, Lori Logan. She came in from New York. I know you've been doing a listening tour around the state. What have you learned in that listening tour from people and how the Fed is affecting them and the communities?
Absolutely. So yes, Lori Logan became our president in August of last year. And to your point, she came to us from a very successful career at the New York Fed. She spent over 20 years there. Before coming to the Dallas Fed, she was the manager of the System Open Market Account, or SOMA, which is basically the desk who executes policy on behalf of the Fed. And so she brought a lot of wealth of information and expertise on not only policy, monetary policy, financial markets, and payment systems. And we are very excited to have Lori join our team. Lori, when she came to the bank, to the Dallas Fed, not being familiar with Texas as much, and the 11th district, one of her priorities has been to learn the district. And there's no better way to learn the district than traveling across the state of Texas, the southern part of New Mexico, and the northern part of Louisiana. And just meeting directly with community leaders, business leaders, banking leaders, general stakeholders, elected officials, and just listening to what are their priorities, what are the challenges, what are the issues, what are the drivers of the local economy, and then how can the Dallas Fed help those respective communities, whether we can help through, shedding some light on specific questions on the economy and the driving forces behind the economy, whether it could be addressing perhaps some community issues, convening. So she's been doing that listening tour along for the last year or so. I've been very fortunate to have the opportunity to travel with her to many of those stops. And so to your question, so what I believe she has learned through this, I would say probably three main things. One is the Texas economy. It's very diverse. There's lots of different economic drivers, lots of industries, lots of different drivers and composition of the different economies. Second,
tell us a little bit about the differences that you can talk about.
What do I mean by that? I mean, if you go to Corpus Christi, you hear a lot about energy. You hear a lot about the global markets. If you go to Laredo, you hear a lot about nearshoring. You hear a lot about trade with Mexico and how Mexico is our top trading partner. If you go to Midland, Odessa, the Permian Basin, of course, you hear a lot about energy and renewables too, not only traditional energy. If you go to Lubbock, you hear about community issues. You hear about ag and to some extent aerospace. Austin, you hear about fintech and high tech in addition to the state capital and the university. So it all depends in which part of the state you think about. There are different drivers that once you put them all together, Texas is a very diverse economy. That's what I meant by diversity. And the second aspect is dynamic. Texas, and we'll get into this later on, but Texas grows traditionally much faster than the US. And today that's the case. And so you go and you hear firsthand, as she's been listening to, and there's a lot of dynamism and a lot of growth that's taking place across the different communities. So diverse, dynamic, but that doesn't mean that we don't have challenges and opportunities for growth. So I think she's also heard that there's a lot of different, I would call them, these are my words, barriers to growth or things that communities have to address. What I mean by that, I think universally we heard about workforce and just as access to talent, not only about the quantity of people that are there available to work, but the quality and the skill sets that those people have. But we also heard about infrastructure needs. We heard about water. We heard about barriers to entry the workforce, such as childcare, digital divides. There's a lot of different things that, depending on which community you talk to, they have different challenges that are trying to overcome. And so I would say those are the main aspects of her listening tour. And like I said, there's no better way for you to do that by traveling to where people are, meeting them, and having just in-depth discussions. And we do that all the time across the Dallas Fed. In all of our communities, we took the opportunity to showcase our new president and get her more familiar with Texas, and she's been doing that.
And as you are traveling, also as you are constantly paying attention to what's happening in our economy on a regular basis, what are the indicators you're looking for as to how the economy is doing for people in this region? So Texas, New Mexico, Louisiana, what are the types of things y'all are looking at on a regular basis to say, is the economy continuing strong for Texans, or is it slowing down, or are things changing? How do you look at those indicators?
Yes, so I would say I always like to argue, that setting up monetary policy, there's a little bit of art and science. The science side of what we do is the phenomenal team that we have in our research department are economists. And they have different expertise, different areas where they concentrate, whether it's national issues, regional issues, international issues. And they have a very specific research agenda, and that's what they do. And they provide phenomenal insights and phenomenal briefing for policymakers across the Fed, including our bank president. So that's the science aspect of it. And in there, I'll get back to that, to your question, how do we think about those different economic indicators? But then there's the art aspect of what I like to argue about conducting policy. And the art aspect is you got to have an ear to the ground. You got to understand from key players on the ground across the country in the different communities, what are they facing, what are they seeing? Because oftentimes, particularly in turning points on the economy, on the business cycle, they are the first one who see things are beefing up, things are accelerating, things are slowing down. And usually data takes a month or 2 or 3 to start seeing those trends, the turning points. So we have a very important initiative across the Federal Reserve, across the Dallas Fed, to really try to connect. And that's why it's so important for us to be there active in our communities. But to your question, so what are the indicators that we looked? When you think about our dual mandate is, like I said, maximum employment, stable prices. Clearly, we spent a lot of time thinking about and looking into labor market dynamics. And there's a whole array of indicators that you can think about. And then on the inflation front as well, there's a whole array of indicators that we looked into to make sure that we have a good understanding and grasp on the economy, and then make sure that we understand what those trends are likely to go so that we can inform our policymakers, and our policymakers can set monetary policy. And in there, so now I would say there's 2 aspects on those economic indicators. There's the short run window. How's the economy doing today? How's the economy has been doing the last, 4, 5, 6 weeks? How is the economy going to look in the near term? And we spent a lot of time doing that, but they're also more long term. For example, what are the barriers for growth for the U.S. economy, for the Texas economy? And those tend to be a little bit more medium to long term. And that's where many of my colleagues in the research department spent a lot of time trying to understand those long-term secular trends, because over time they have significant implications for the economy, and therefore significant implications of how the Fed ought to think about policy and economic prospects. So it's a wide range of indicators. We spent a lot of time thinking about economic activity, particularly labor market, and of course, inflation dynamics.
So the Federal Open Markets Committee this time did not choose to raise interest rates. In the meeting about 10 days ago, I think. All my days are mixed up a little bit these days. Last week, see, and I think that one of the reasons is the economy has somewhat slowed. What does that mean for Texas? Like, if you don't raise interest rates right now, what does it mean for us? Does that mean the economy has slowed? Does it mean that we feel like it's slowing down? What does that mean for us?
Yes, so you're right. The Federal Open Market Committee, they meet 8 times a year, and they assess economic conditions, financial conditions, and then they determine the stance of monetary policy for the country. They met last week. The composition of the Federal Open Market Committee is 7 members of the Board of Governors based in Washington, D.C., appointed by the president, confirmed by the Senate, and then the 12 regional bank presidents across the country. So those 19 individuals are the policymakers, and they are the ones who sit down 8 times a year and discuss, again, economic and financial conditions. They met last week, and they decided to leave the Fed funds rate unchanged. Now, to your question, so what does that mean? I mean, at the end of the day, when you think about monetary policy, is the Federal Reserve, the central bank, influence the cost of money and the cost of credit. And what do I mean by that? It means that if interest rates were to be low, then you and I probably will be more prone to buy a home, get a mortgage, buy a car, get a car loan, get a new piece of furniture for the house, and perhaps finance it because interest rates are low. And so you stimulate the economy, and then you have economic growth, right? If interest rates are high, it's the opposite. then you and I may not be buying a home. You and I may not be buying a new car or a new piece of furniture. The same applies for businesses. And they make those decisions depending on where credit and the cost of credit is. So to your question, and I think Matt alluded to, when we started the year in 23, we were expecting the U.S. economy and Texas to grow, but to grow in a moderate pace. And now we got to keep in mind, we're coming back from 21 and 22, which we had closed the economy in 20, we reopened the economy, and we had very strong growth, but both at the national level and at the regional level, both in 21, 22. So we were expecting growth, but we were expecting growth to start decelerating just because coming back to trend levels. That's at the beginning of the year. Fast forward to today, what we've seen a far more resilient U.S. economy, and we've seen growth being stronger than most economies would have anticipated earlier in the year, and the same is true for Texas. So our job forecast for Texas for 23, it's about 3%. So if you look at what we've seen thus far year to date, and then what we expect to see to the end of the year to get to that 3%, we've seen growth start to slow down in Texas. And so in order to get to that forecast, probably Texas is going to grow about 2% for the last portion of the year. So to your point, we do see a slowdown in growth in Texas, coming back to more trend level. Trend level growth for Texas about 2.1%. And we're anticipating that. And that's in part because of what the Fed is trying to achieve. The Fed is trying to achieve price stability. Fed's trying to achieve bringing inflation down to the 2% goal, been raising interest rates very aggressively since March of 22. And as such, we should expect the economy to start slowing down. And I believe we're beginning to get some of those readings for Texas, but that's still positive growth. We're trend growth. So I don't want people to walk away to perceive that the economy in Texas is going into a negative territory. At this point, we don't expect that. We don't see that for the remainder of the year and for early 24. But we do expect growth to moderate more into a trend level.
Yeah. So let me dig into that for a second. Growth is happening. Economy, there's enough jobs, especially in Texas. There's, I think, 1 million jobs that are open. But expenses have also gone up, right, because of interest rates. Everything has become more expensive. It's more expensive to buy a house. It's more expensive. A cup of coffee now is no longer $2. It's like $4. What does that mean for people as they are trying to manage their daily lives, and the interest rates are staying up at around, I think the 30-year mortgage is around 7%. What does that mean for daily lives of people? Is debt going up? And I've seen that credit card debt is going up. What does that mean for us?
Yes. So, if we can spend maybe a little bit of time on the inflation that you alluded to, absolutely, that's what we've seen, and that's something that's been our top priority for Dallas Fed, for the Federal Reserve System. When you think about prices, when you think about inflation, what we've seen over the past 2.5 years is we've seen demand basically outstripping supply, and therefore things becoming more expensive. There's a whole array of issues as to why we believe demand has been stronger than supply. It has to do with the pandemic. It has to do with the business cycle. It has to do with supply chain issues. It has to do with monetary policy, fiscal policy. We were trying to stimulate the economy during the pandemic, and now we are on the tail end, and we see demand outstripping supply, and therefore things becoming more expensive, from goods to services all across the economy. And so we're trying to bring inflation down to the 2% target. To your question, so what does that mean for the average Texan? That means that they are therefore allocating more of their monthly budget to meet and to make ends meet. And that means that it's putting pressure on households, it's putting pressure on businesses, because things, to your point, are more expensive. And that's something that we believe we need to bring inflation in check, and we need to bring inflation to the 2% target. And in order to do that, we have to raise interest rates, make the cost of money more expensive, so things will slow down, and with the hope that we will bring and the goal to bring supply and demand in line. Because if we don't, not only are households and businesses, as I was mentioning, are struggling today to meet their needs and meet their commitments. Our concern is that that we want inflation expectations to be well anchored. We want businesses, people to think, well, inflation is out of the range of the Fed, but the Fed will bring inflation down, because over long periods of time, having stable inflation provides the best recipe for continued growth for the economy. Will be less volatility, less cost to businesses and individuals. So that's why it's been our top priority for the last 2 years or so. We are making good progress. We are not there where we need to be, and so that's why the Federal Open Market Committee continues to be very vigilant. To your point, they decided to pause or to not move rates this last meeting, but they'll continue to, I'm sure, to continue to track conditions and then make the appropriate decisions for monetary policy going forward.
Let's talk about Texas economy. You said Texas economy has been growing at 3%, which is faster than the rest of the country. Why?
So why? A number of reasons. The industry mix, it's very diverse. And we've seen tailwinds, for example, from the energy sector. We've seen tailwinds from the trade sector. Texas is not only the largest energy producing state in the country, but it's the largest exporting state in the country. And both of those markets have been very strong. We've seen growth being broad-based. And the other factor, too, that broad-based growth is the movement of businesses and people into our state. We saw that before the pandemic. People moving predominantly from the coastal areas, California, the Northeast, a little bit from the Midwest, Chicago in particular. What was very interesting is during the pandemic and after the pandemic, we've seen those trends of people moving into Texas accelerate. So these people come in, businesses come in, and they continue to create growth and job growth and just economic activity. Those are the main drivers, and that's why Texas continues to be very dynamic. Why are businesses coming? Based on what we're hearing from them, it's very low cost of doing business, very friendly to businesses, so that's attractive for businesses and attractive for families to move to Texas and raise their families here. One of my colleagues, a few of my colleagues did some work thinking about not only people moving into the state of Texas, those domestic immigration, but thinking about, do people leave? And what they found is that, quote unquote, Texas is the most sticky state in the country. What do they mean by sticky? 82% of the people living in the state were born here. So people who are born here don't leave. So that's one. Then we also know that there's a lot of people coming in to Texas. And what they found is that people who come into Texas don't leave Texas either. And so then you get this dynamic of population growth, and that creates a lot of dynamism. When you think about an economy can grow because of we have two main levers for growth. We either become smarter about how we do things, meaning productivity growth, or there's more of us, meaning population growth, labor force growth. And what we've seen in Texas, we've seen a very strong dynamic on the population growth because of immigration and because of this stickiness, and that has propelled a lot of growth as well.
So what does that mean for us if we have migration coming in, less out-migration because people are staying? What are our challenges, right? Because we're growing so fast. Are we keeping up on the education front, on the transportation front? Like, what does that mean, and how do we manage to that?
Yes, and obviously growth comes with some demands, right? And the state and communities have to meet the demand, the growth in their population. And you brought some of those. Of course, we need to make sure that we have the proper infrastructure to support not only the people that we have, but the people that we anticipate are going to be coming in and the industry that is coming in. And that can take many shapes and forms. Like I mentioned before, we were in Laredo a few weeks ago, and it was a lot about international ports of crossing and making sure we have the infrastructure to enable and facilitate the growing trade with Mexico. If you go to the Permian, it's about education. It's about healthcare. Mental health in particular. And if you go to Corpus Christi, it's about water and the port. If you go to Houston, it's about education and innovation. So there's a lot of housing in Austin. It's I was talking to some of you in the audience before coming to the stage, and clearly there's a lot of dynamics going on in the housing, whether single or multifamily in Austin. And those are things that we need to make sure that we are prepared to continue to sustain the growth, and more importantly, continue to perhaps prepare the state and the different communities to going forward, because we don't expect those trends to reverse, and so we should expect Texas to continue to grow going forward.
And how does the Fed, and specifically the Dallas Fed, think about broad-based growth? So, in Austin, housing prices have gone up fairly significantly for average Austinites who live here. What does it mean? How do we think about broad-based growth? How do we make sure the middle class is also growing and not just it can open up for everybody? And how do you all think about it from the Fed perspective?
Yes, and thank you for asking that, because we strongly believe that it takes all of us to build a strong economy. A strong economy that it's including everyone, and that all of us are experiencing a strong economy. So how do we think about that? A number of ways that we think about. One is when we looked at the data, when we track trends, we make sure that we, to the extent possible, dissect the data and understand, labor market conditions, unemployment rates, income growth, or wage growth. Are those, we see the overall trend, but if you look under the hood, do you see any substantial differences between segments of the population? And if so, we want to understand why. Why are some segments of the population experiencing a different economy than the overall trend? So we spent a lot of time thinking about that and looking into those trends. The second aspect, talked a little bit about the five items that the central bank takes a look at, and one of them is community consumer related issues. And in there, we spent a lot of time addressing and talking to community leaders and understanding what are the barriers that they're seeing for the local communities, and how can the Fed shed some light through research and through economic insights, and also as a convener. We've learned that we have a good convening power across communities. And so if there's a specific community who's trying to address a specific issue, say the digital divide in the Rio Grande Valley, we, the Dallas Fed, can serve as the convener, bring the people, from the private sector, from the public sector, from the educational sector, from different sectors in the economy, and say, okay, this community is facing with this challenge. How can all of us put our minds together to address those challenges? And in there, we got to be really careful how do we do this, because we are an independent central bank. We cannot take sides on any given issue, but we can't be, fact-based, research-driven, and convening, and then let those players in the community really come to the solution of their respective issues that they're addressing. So we do a lot of that. We have a very active community development team across our district, and spend a lot of time thinking about small business lending, access to healthcare, access to housing, access to broadband, access to childcare. All of those are different barriers that people face to enter the economy and experience the economy fully. And so we do, and I would encourage you to please visit our website, and you can, I'm talking about very general level, but there are specific initiatives in your communities that perhaps we are being part of, along with the local partners in the different communities. So please encourage you to visit the website and get more familiarized with the different work that we're doing across the state of Texas.
Yeah, I mean, if I'm not wrong, you don't have just general economists. You have people working on energy, education, health across the the Dallas Fed, don't you?
We do. And we do for a number of reasons, because those are key issues and key industries for our district, and we need to make sure we understand what are the drivers and what are the trends. But for example, on the issue of energy, for example, as we think about the trading relationship we have with Mexico and the trade flows and cross-border manufacturing with Mexico, as we think about technology in Austin, those are key industries, not only that make up the 11th district economy, but are unique to the nation. And so we believe that it's not only important for us to understand those for the work that we do at the Dallas Fed, but for us to then shed some light and be thought leaders in those particular issues for the Federal Reserve System. because those issues matter not only for our district, for Texas, but they matter for the country. And so that's why we spent a lot of time connecting with those industries, understanding those issues to then help inform the overall Federal Reserve System and the policymakers on those key issues.
And Roberto, let's go to jobs for a second specifically. Economy's growing. Texas may slow down a little bit. We'd like to talk. I'll come to that in a second. How do we train for jobs for the future? Like, how do we think about the future here? Because they're changing rapidly. You have technology changing rapidly. How do we think about our population, our students? What kinds of jobs are we training for? And how does the Fed engage in that?
Yes, and as a parent of 3 boys, one who's a freshman in high school, we have that conversation over dinner every night. And then the 2 little ones, eventually we'll have that conversation with them too. So the economy is very dynamic, and I think the pace of change perhaps only accelerate after the pandemic. The economy is always evolving and always churning, creating new sectors, destroying other sectors too. So that's something we have to keep in mind as far as workforce development and reskilling and retraining. But to your question about Texas, so let me share maybe a few statistics that perhaps will put things in perspective. It's believed that about 2/3 of the jobs in Texas will require some kind of post-secondary education by 2030. 2/3 of the jobs in Texas will require post-secondary by 2030. About half of in Texas have that degree. So clearly we have a gap. About 1/3 of high-wage, high-demand jobs between now and 28 will not require a bachelor's degree. And those jobs are predominantly in in manufacturing, construction, and other technical fields. So the dynamism of the economy will require us to really think holistically about the talent and the skill sets, not only about 4-year educational institutions, which are very key to the growth of our state and the country, but also community colleges and technical and career training. And so we do, in fact, as a matter of fact, recently, some of my colleagues published an article or a study on the community colleges in the state of Texas. The role that they play, the role that they've been playing, the role that they will continue to play, and it's a very important role to continue growth for the state of Texas going forward, because it's 1/3 of those jobs in the next decade will need to be produced in some of those institutions. So we looked at the entire ecosystem, because again, our goal is maximum employment and price stability. So we need to make sure we understand what is the pipeline of talent, and so that's something that my colleagues, and not only at the Dallas Fed but across the system, spent a lot of time thinking about. What are the future jobs? What are the future skills that we need? Do we have the institutions and the infrastructure to produce the talent? And if not, then how can the Fed think about those issues, and how can the Fed help address some of those issues?
So let's start with community colleges. Are we moving fast enough? Can the community colleges take in the in-migration and the growth of our population, which is young, to manage that much change on a regular basis? And how do you all interact with the different institutions in thinking about where that dynamic is going?
Yes, and so we interact with them on multiple fronts. I'll tell you that something I didn't mention is that we have boards of directors of our respective offices. In El Paso, one of our board members happens to be the president of El Paso Community College. So we hear from him firsthand every time we meet. What are the issues? What are the challenges? And of course, he brings insights into more broadly into the state of Texas. To your question, I mean, Texas community colleges are very unique, and in many ways, and that's what my colleagues found in their study, because they didn't only look into the Texas structure of community college, but they compare vis-a-vis to other parts of the country, and they found that in Texas we have pretty unique and innovative and very a model that produces good results. There's opportunities for growth, and you can look into those in the report. But this is something that community colleges traditionally have been very nimble and pivoting. So in El Paso, I can tell you that as truck drivers has been an issue, they've pivoted quickly and start beefing up their truck driving curriculum. And in some years, they've struggled locally to produce folks for law enforcement, so they beef up their law enforcement credentialing and school. And now they're doing a lot of computer programming. So community college tend to be not only in El Paso, but across the state. And the best models that I think we've seen is when those community colleges have strong partnership with the business community in their localities. So they understand firsthand what are the local businesses needing today, and how can I, the community college in Community A, start producing the talent that they need. So the best models that we've seen is strong partnership between the private sector in the respective community and then the educational institutions in that community as well.
And as you think about the need for more post-secondary education, how do you think about student debt? And like, what does that mean for students that are going to post-secondary, acquiring debt, and then how they can afford that? How do you all look at it from the Fed perspective?
So we do, and we have folks who take a look at that. So absolutely. So, I mean, generally speaking, I think that the conventional wisdom continues to be the more you learn, the more you earn, right? I think that's universally still true, and I would expect to continue to be true going forward. However, as the economy evolves, we may have needs and gaps and in specific occupations, in specific industries. And so that's why we need, to have better understanding what those drivers and what those sectors are coming up, so then people can react, so that my son, who's a freshman in high school, can say, okay, I was thinking of studying X, but based on what I think I know about that X industry, maybe I want to pivot to industry B or industry A, because there's more prosperous growth going forward. So there's some of that. Now, we've I think, heard this and seen the statistics at the national level on student debt, and it has put many young people in a difficult situation as they finish their degree, and then they have to enter the labor market, find a job, make ends meet, particularly in today's environment with higher inflation and higher costs, and then they still have to service that debt. And no doubt that for segments of the population, that continues to be a struggle, and many of them deal with it not only for a few years after they finish their degree, but for multiple years. So that's something that we looked into it, and what sort of implications would it have for the overall economy.
Yeah. And I mean, I will just say, I think for also many parents are deciding whether their kids go to a 4-year university or not based on how much debt they have to take on and whether they can afford it. So I think this is an ongoing conversation. But I'd like to switch a little bit to thinking about the Texas market. The economy in Texas. You said you expect it to go from 3% to probably 2% through the end of this year. I'm just dig into a specific aspect of that, the commercial debt market. When you look at Austin or Houston or other places, there are many buildings that are vacant. What does that mean for our economy?
Yes. So, and I'm assuming you're referring to commercial real
Commercial
estate.
real estate. Sorry.
Yes. And so, yes. So that's something we look carefully. So it's an interesting dynamic, because if you think when the pandemic hit, one of my colleagues spent a lot of time thinking about what's the proportion of the workforce in different markets in Texas who can quote unquote work virtually, work remotely. Nationally, I think the number that he estimated was about 40%. 40% of the national workforce could work from home. For Texas was about the same, 39%, so it's pretty much the same. Austin was the city who had the highest number, close to 50%. And so if you think about how the different economies and different markets in Texas perform over the pandemic, Austin was very strong because people just stay home, despite of what was going on with the global pandemic and the health issues and all of that, and continue to perform and do their thing, right? Fast forward to today, that 50% is still there. So they are still working from home. And that's why we hear from businesses that they are having a hard time trying to bring people back into the office. And Austin is, I think, is one of those communities. There's other communities across the country. If you think about San Francisco, New York, Chicago, the businesses are having difficulty bringing them back into the office. Houston is there too. And so that creates interesting dynamics from a commercial real estate perspective, because to your point, to the extent you have infrastructure, you have a building, you have office space, and that fully utilized, that comes with a cost. And then the economy has to work its way through that. And yes, in Texas, I would probably say that the markets where we have the highest vacancy rate in office space is Austin and Houston, and that's something we track very closely.
We're going to start questions. So if you have questions, please do stand up. One last question before we go to questions, both online and in person. If banks are holding on to this commercial real estate debt, what does that mean if companies or others choose not to pay it at some point?
Yes. So what does that mean? Well, it could be very hypothetical examples, but if that's the case, then that will put some pressure on the banks who are holding that debt. And that's something that our banking supervision team and regulation are paying a lot of attention, making sure we understand those dynamics and make sure that to the extent we have risks, that we identify them and we're working actively to mitigate them. And so, yes, that would mean that if that were to happen, it would put some pressure on whoever's owning that debt.
Please.
One thing I haven't heard about is the climate situation. We had over 72 days straight over 100 degrees here in Austin. The extreme heat was severe in many states, including New Mexico and Arizona. Plus, with the extreme heat comes greater use of water resources, the groundwater. How does this kind of information impact economic studies, analyses, recommendations for the Fed?
Thank you. And so one of the areas that we've put a lot of emphasis, not only us in Dallas, but many other regional banks, is that we conduct surveys of different sectors of the economy on a monthly basis for us in Dallas. And so we have a survey with around manufacturing, energy, services. And what we learned in the last 2 months or so of those surveys is that the heat wave that Texas faced over the summer, that all of us faced, regardless of where you were in the state, actually had some impact for economic activity. So a quarter of businesses across the state said that they were impacted negatively because of the heat wave. It was not felt the same across industries. Leisure and hospitality, for example, was hit the hardest. So when it's really hot, you don't want to go to a restaurant. You don't want to go to. You want to just stay inside, right, and stay in the house. So we saw that, and so that was very interesting findings that we just learned. To your question about maybe more long-term issues, whether it's electricity, whether it's water, I think those issues is going to take a little bit longer for people to find out what are the implications of a summer like the one we just faced. But I can tell you, businesses are telling us quarter of them were negatively impacted by the heat wave in Texas. So it's not trivial, and there's an impact there.
I guess my question is on the same regard, because this is a long-term thinking ahead. But and I appreciate that the banking board is independent. But for Texas particularly, do you consider or do you talk about the women's issues, the education issues, and the library issues that are happening politically, basically, in Texas, and how, we have friends and family on both coasts, and they would not move to Texas because of the women's issues and other issues that Texas faces. So do you ever talk about things like that?
So we take a look at those from an economic lens, and so what are the implications for the economy today? What are the implications for the economy in the future? And so we have economists and we have analysts who track those issues, but we ought to be very mindful of what's my words, swim lane, and our swim lane is monetary policy, and we need to the extent those issues have an implication. Yes, we take a look at them, and absolutely we do.
Sorry. So my question is, in terms of roads, like in Texas, right? It's very widespread. So there's lots of roads, which means that there's a lot of traffic and cars. And how does the Fed like analyze and look at how roads and like investments in actual highways actually help with, or like the debt in terms of the economy and also the communities inside the economy? Because I know that low income, like, you know, car loans are becoming, you know, more expensive, and, you know, just the gap between all of that in terms of
Yes.
transportation.
So we usually looked at it from a barrier to enter the labor force. It is transportation cost, and for many folks, that's a big barrier, and that's an impediment for them to find a job, or go to seek medical health, or go to school. Interestingly enough, that's an issue. But when you looked into the surveys, when we looked into people who we talked to, that's perhaps not the top issue today. Today, the top issue is access to childcare, access to broadband. Those seem to be more prevalent barriers for growth and for entering the workforce, and that's where we've been putting a lot more emphasis. I'm not saying that the transportation costs and transportation is not an issue, but we have not put a lot of emphasis there because it simply doesn't go to the top of the list.
What about the state, that the real estate that actually happens because of its relationship with like actual transportation for like zoning and roads and, like, you know, parking lots?
Let me
and stuff like that,
let me offer a slight variation here on this question, which is, are we know more broad-based growth happens when transportation is more easily available, and when it's limited and you have to drive to get to places, it makes it harder to have broader based growth. So how does the Fed look at that research?
Yes. So no, absolutely. I mean, transportation, access to public transportation, access to reliable transportation, it's critical to have a thriving regional economy, thriving labor market, making sure people are included into the economy. And so how do we look at that? We looked at that predominantly through our community efforts and through our listening sessions and understanding what those issues are. From the Dallas Fed, I'll have to think through, you know, exactly have we done work around those issues from a research perspective. There are other reserve banks who are putting emphasis there at the national level, but we simply in Dallas have not had the opportunity to spend too much time there. And maybe that's what I was trying to share with the person who was asking the question.
Yeah, please.
So, as the cost of living rises, and as people are having to resort to using more credit and or making ends meet just barely by, they might have to cut back on spending on non-essentials and having to spend more on essentials, and those kind of decisions impact the economy, since a lot of American-made widgets, gadgets, etc. are quote-unquote non-essentials, but those non-essentials are also what drive the economy. And so I want to say, how do you address the fact that like people are having to rely more on credit or having to maintain their margins of like making ends meet? And how are you going to, I wouldn't say how would you address that situation, but how does the Fed look at the situation and come up with policies to address the issue of reducing the credit needed to make ends meet?
Yes. So we look, and that's a very ongoing debate within the Fed. And by that, what I mean is, what's the stance and what's the health of the consumer? 2/3 of the U.S. economy is made by you and I, the consumer. So the consumer drives 2/3 of the U.S. economy. And so what the issues that we're looking in there is, are there savings? What's the savings cushion that households have in the U.S.? What are the balance sheets of households? What are the income and wage drivers? What are the job prospects for the average household? But then we looked into, okay, consumer, right? Where are people spending money? And to your point, what we are hearing more from contacts is that people are substituting goods from quote unquote luxury goods to more necessity, first line type of goods, because to your point, things are becoming more expensive and therefore they have to rationalize their budgets and meet their budgets. So we're hearing a lot of that substitution going for the consumers when we talk to business leaders across the district. But to your point, what does the Fed do as far as policy. I mean, the only policy lever we have is we set interest rates, right? It's a very big, bold policy lever that we have. We don't necessarily set policy to address those issues. However, something that we do and we very actively across our communities is by providing financial capabilities resources. And what do I mean by that? We go across the district and have materials and resources so that people can get a better understanding of how to manage their personal finances, and with the intent of equipping them with the tools and the skills that they need to then make the decisions they need to make. But we don't have any policy levers that we can address those specific issues.
But you are talking to government and business owners all the time, so you do see that. And I just want to add to that. I think just to the question of, there's also other indicators that start showing up that are lagging indicators sometimes from the Fed perspective, which is debt is increasing. We're seeing, food banks seeing more lines coming in, more people coming in to get essentials on a regular basis. How do those feed into sort of what you're seeing at a very local level that feeds into the FOMC?
Absolutely, and thanks for bringing that up. Yes, so when we talk to business leaders, of course, we look at the national trends, and we're seeing that perhaps credit card debt is growing. We're seeing that perhaps households are putting more on their credit cards and taking a little bit more debt to make ends meet or meet ends. But when we talk to different business leaders, I was talking recently to someone who's in the insurance business. And then the contact was telling us that there's different cycles in how things unfold, and they were starting to see people perhaps not paying their auto insurance as often. And it's okay. So tell me, what does that mean? And because I'm not in that business, and so then he goes into explain. Look, this is usually the first domino that falls. And then eventually people are going to struggle, make the car payment, and then eventually may go into not paying health debt, then maybe the home. And he said there's a number of months in between them, but this is the first, signal, if you will. And so then we're learning and we're talking to that business leader and other business leaders. So tell me more about exactly how to start reading and connecting the dots, because it's important for us, because that might be a turning point. It might be a one-off. We don't know, right? But those are the issues but that's the art aspect of conducting policy. Talking to those business leaders says, help me understand, how do I connect these dots to the overall trend? And is there something we need to take from this and inform our policymakers for them to be aware of this? And there's a strong team of colleagues of mine at Dallas Fed who do this day in, day out. And that goes to your point that we talk to business and community leaders all the time.
Yeah, please.
Thank you for this conversation. I appreciate your participation and sharing that. This may be a little bit of a rhetorical question since you don't represent the Fed particularly in terms of your statements today, but I'm just wondering if the Fed's policy tools are a little bit antiquated or out of date at this point, just by manipulating interest rates or balance sheet transactions from the Fed. Trying to maintain inflation at a 2% level that Chairman Powell has mentioned during a time when we're going through reshoring of bringing manufacturing largely back to the North American continent is very inflationary. The infrastructure bill that the government passed is inflationary to retool both our broadband database, our infrastructure, as well as our roads and bridges. And then we have a demographic shift of baby boomers retiring, but millennials and other generations coming in that need new skills for AI, machine learning, 3D printing, and other skills that need to be upgraded. So I'm just wondering if the Fed has too broad of a mandate, or it's set a policy at 2% inflation that's kind of not really achievable. It's unrealistic, maybe, given all those constraints.
So thank you for your question, and that's an ongoing conversation by the economics profession, right? As to what are to your point, those are secular trends that the U.S. economy is facing, and I would argue many other global economies are facing similar or same secular trends. But you are you started the question by prefacing what my answer would be. Yeah, I don't think it would be appropriate for me to make any comments as far as the tools that the Fed has. I mean, those are for the policymakers, and then also for elected officials, right? For Congress, because Congress delegated that to the Fed, and so those are discussions for them to have, and would not be appropriate for me to make any comment.
I believe you have an online question.
We've received a few online questions that are speaking to the different measurements and indicators you and your colleagues use to determine monetary policy. I think you've touched on those, but related to that, as we think about the general public as Texans and we go about our lives and thinking about this program, how else should we be paying attention to the economy and different forces as it impacts our lives, our families, our communities?
Yes, so thank you for that question, Matt. We do all of this work for monetary policy purposes. We want our policymakers to be as informed as possible. But then we turn around and say, now that we've gained this knowledge, now that we've gained this expertise, the very least we can do is share that with the overall public so that they can take that information and then hopefully make more informed decisions. That's our ultimate goal. And so to your question, I would encourage the people listening in and people from across the state of Texas to check our website and try to become more familiar with the economy, with your community, try to be more involved and understand what are the different drivers, what are the risks to the economic outlook, and then what does that mean for your dinner table conversation, right? Then how do I bring that to what am I trying to do for next year, next summer, whatever it is that you're trying to do for either your business or your family. And I think we have a lot of information out there, and I would hope that people take advantage of that. But that's our goal, is put it out there so people can use it and leverage for their own decision making, whether it's a business or whether it's a household.
And Roberto, on the community aspect of it, I'll just finish with this. On the community aspect, how do communities interact with the Dallas Fed? How can they interact with the Dallas Fed and participate? There's going online and trying to read a lot of information, but there's also, I know you all do community conversations. What does that look like?
Yeah, so what does that look like? We often are approached by any of you and say, you know what, I live in Austin, Texas, and I'm working on this project or working on that issue. Do you have any information that may help me? Do you have any expertise? Do you know people who are doing similar work in other communities across the state of Texas that I can lean on? And that's usually how the conversation starts. And then one thing leads to the next, and then before we know it, we're convening a community roundtable to address that specific issue, and then we've done research. So I would say it starts by just pick up the phone, send us an email, give us a call, and give us the opportunity to engage with you and see if we can help. Now, in many cases, we will say, you know what, as much as we would like to help, we don't have the expertise, or that doesn't fall within our swim lane. So as much as we would like to, we cannot, because we don't have the resources or the expertise. But in many cases, we can. And so absolutely, that's usually how it goes. We go to the communities, we host events, we invite the public, participate, engage with us, and we'll see where things go from there.
Well, thank you for being here, and thank you for this conversation. We hope to continue to have more conversations on the Texas economy, and we hope the Dallas Fed will continue to work with us.
Absolutely. It will be a pleasure. Thank you for having us today.
Thanks, everybody.